This is the Retirement Key Podcast with Abe Abich, founder of Abich Financial Services.
We are surrounded by information in a way that the generations before us never have been, Abe. And
yes, we are.
It's a good thing in many ways, but it can just really complicate a lot of things.
It can be overwhelming too.
A little bit.
Oh, yeah.
Just before you get out of bed and you feel like you're already sipping from the fire hydrant. Today specifically, focusing a little bit further in on our investments and how we need to adjust our approach, our mindset, how we figure out how to adjust our approach and our mindset for our retirement. Because for so many of us in our working years, we spent our whole life saving to a 401k, watching all the market runs that we've seen over the last several decades really give us some great benefits, but we got to adjust that as we get into retirement. So the how-tos of it, unfortunately, it's more complicated. It becomes more and more complicated. And Wall Street is not being very nice to us. I'm going to tattletale on Wall Street. They're calling us names, and I don't like it because we are smart men and women here. But Wall Street has a nickname for us everyday investors, and it's their words, not ours. The dumb money, apparently, is what we are referred to.
Wow.
So this assumption is that regular people tend to panic, chase trends, we make emotional decisions, while the professionals, they stay disciplined. Because, on Wall Street, all those professionals up there on Wall Street, they know exactly what they're doing and stay disciplined all the time, right?
Not all the time.
If only.
Not all the time.
Some analysts do say that individual investors, this is where the story gets interesting. Listen to us, lean in closer to your radio speaker. Some analysts say individual investors have been surprisingly resilient during recent market sell-offs. Robinhood's Steve Quirk was telling CNBC that they, us, the dumb money, have stepped in to buy when others were selling.
They're actually very savvy. They bailed out the market during COVID, and they bailed it out again during the tariffs. Like, they were aggressive buyers.
That's right, we were, because we are not dumb investors. We are not the dumb money. We're the smart money, Abe. But we have spoken before on this program about the emotions that so quickly come in when we do see market downturns. So when we see a tumble, is buying the dip a smart move, or is it a costly mistake, or is there somewhere in between? How, especially in this next phase in our retirement, how should we approach?
Yeah, we have seen so many successful do-it-yourself investors come in. So many resilient investors that have stayed prudent, that have stayed disciplined, that haven't chased the trends, that have bought the dip, and when the opportunities, they have bought more when the markets are down, and also have continued to pour more money into the markets and into their financial plan, whether the markets are up or down. And usually when we see people, Heather, they're at the point of retirement, they're in their late 50s, early to mid 60s, they typically have several million saved on average, and that's because of being prudent and disciplined for 30 plus years. So we see a lot of people who have done really well, but we compare retirement planning to climbing up and down a mountain. And for me, it's quite simple when I think about this, right? When you're climbing up a mountain, you're going up the ascent, right? And it's pedal to the metal, head to the ground, saving as much as possible, maxing out your 401ks and TSPs, taking on risk because you're in your 20s, 30s, 40s, and you have a lot of time before you get to your 60s and can retire. But then the closer and closer you start getting to retirement, you wake up one day and you say, man, I just hit my first million. I got my second million or third million. It's like, you know what? I feel like I've hit my number, or I'm getting close to my number. Maybe I should start reducing the risk a little bit because now I'm 55, 58. I'm getting closer to retirement. Not going to go back to work. I don't want to go back to work. I want to retire and enjoy my money, right? So we get to the top of our retirement mountain, and we need to and want to descend down safely. So we go from pure growth to growth and income, or we should be going from pure growth to growth and income, so that now we can replace our paychecks and enjoy the fruits of our labor over the last 30 to 40 years. So we have certainly seen disciplined, prudent, resilient investors come in, and it's just nice to see. And it's proof that if you stick to your own plan for a long time, it can typically work out, right? So what are retail investors doing? According to Citadel Securities, this dip buying activity reached its highest level on record over the last 6 months. On the days when the S&P 500 fell, retail investors bought stocks at 3.5 times their normal pace. I think that's because when you've been in the stock market for a long time, it's going to go up and down. And that when there's dips, eventually, probably, it's going to rebound, right? And come back around. And so that could be an opportunity. Confidence during sell-offs. Many investors see falling prices as an opportunity rather than a reason to panic. And again, retail trading activity hit records in May and June, suggesting more investors are willing to put money to work during periods of uncertainty. And so that can be great. Now, where it can be a challenge is if that happens at the point of retirement, your portfolio is down 10 to 20%. You don't have anything safe built in there that you can access that hasn't gone down when the markets have. That can be trouble if you don't have those safe buckets of money to go to that you can depend on. And so it's been a different approach than Wall Street. While Wall Street often assumes individual investors act emotionally, many have been buying during market pullbacks rather than selling. And that steady dip buying has become and can become a meaningful force in the market. We just recently worked with a couple in their late 60s. They're retiring in about 2 to 3 years. He's going to retire by 70, so he's 67. I think she's 68. Okay. They live here and in Texas. And the main problem with what they had done is that they were do-it-yourself investors until the point of retirement. They had gotten to $4 million. Great savers, just didn't know how to protect it, preserve it, and distribute it. Right? They wanted to know, how can I enjoy it? Mm-hmm. We've gotten here to the point of retirement, Abe, and we've got TSPs, 401ks, and IRAs, and we feel like we've done a really good job. And that doesn't even include, cash in the bank and real estate properties. But now, we're in our mid to late 60s. We want to enjoy it. We don't want to run out of it. We also want to protect it and make sure it goes to our kids and grandkids because they have a bunch of them. So we put together a portfolio x-ray so they could understand what they were invested in, what they have, right? The pros and cons of the investments and all those accounts that they put together. And we showed them how they could start shifting from pure growth, pure pedal to the metal, pure return focused to growth and income focus. We built in a distribution plan to help them protect and preserve that $4 million, to continue to grow it, but also to produce income and to reduce taxes all in one plan. So you don't have to go to this guy for that, service, this guy or gal for that other service, this guy or gal for that other service. You really should be able to put everything you have together into one comprehensive, cohesive, consolidated retirement plan. We did that all through the portfolio x-ray and analysis that we talk about on the radio show week in and week out. If you're 55 years old and older, you've saved $500,000 or more for your retirement. In investable assets we can help you to manage, we want to put together your very own customized portfolio x-ray to show you the pros and cons of everything you've done up until the point of retirement. And if it's right and best for you as you head into what we call phase 2, that descent down your own retirement mountain, complimentary.
Abe, real quick, before we get into our next subject, I wanted to make mentions because you brought up the retirement mountain analogy, and we haven't talked about it in a little while. Your book that you published last year, The Retirement Mountain, The 7 Steps to a Long-Lasting Retirement, is a great place for pre-retirees or even early retirees if you are realizing that you've gone into retirement but you don't have a true plan. A great resource to begin getting some ideas, collecting your thoughts, helping to walk you through some of those initial thoughts. It's only about 100 pages long. I think it'll take you a Saturday afternoon to read. And we do have complimentary copies for those who come into the office for an appointment. Also options for you to download a digital copy up on the website, theretirementkey.com. Click on the media tab, choose book. You'll see links there. And just speak to a little bit about what somebody can expect to, what your goal is for a reader to get from this book.
Yeah, so my goal in writing the book was for anyone reading the book to understand what they need to know at the point of retirement and building together what we believe is a comprehensive retirement plan at the point of retirement, right? It's much more than just your money. It's your money and everything that you want the money to do for yourself and your family, right? Yeah. But Heather, as you know, there's so many decisions you have at the point of retirement. So how do I make the right Social Security decision? And then, I've got $3 million. How do I reduce taxes as much as possible? And by the way, Abe and Heather, I want to pass on money to my family. How could I do that? Mm-hmm. And also, Abe and Heather, my mom is in her early 90s and still living and kicking and doing well. And, I plan on living long as well. And how can I protect against a healthcare event? And so all of these things that we talk about in the book, we believe can be put together in a comprehensive retirement plan that could end up being successful for somebody if they do that. Well, so that's what we wanted the readers to know is how do you put together this plan that should be different from the plan that you had in your 30s, 40s, and 50s? Because
it's a different phase of life, different goals, different objectives. Correct. And you, of course, just working to put the information into people's hands, into their minds. That's the goal of Abe writing this book. He just wants you to have a resource, a place to begin to empower yourself. So again, The Retirement Mountain, The 7 Steps to a Long-Lasting Retirement. a complimentary copy for those who come in for an appointment. You can also buy it on Amazon, or you can download the digital version for free. Just go to the website, theretirementkey.com. Click on the media tab, choose book. You'll see more information. We've got everything up there posted for you to download and consume. We were starting off talking about our market risk and how to better adjust in retirement. That's just one area of a plan, Abe. And when it comes to different formulas to apply to our plan, there's always new ones coming up, or old ones become new again. And what we like to do here on the radio is to put those rules, those ideas under the microscope a bit, get your opinion on them. So one of the rules is the rule of thirds. You listen to the radio, you may have heard that before. The idea is you divide your savings evenly into 3 buckets: guaranteed income, fixed income investments, and equities. What are your thoughts on this rule of thirds?
I really like it.
Okay.
We talk about with our clients often, monies in terms of buckets, right? We believe you need a bucket of money for emergency funds. We believe you need a bucket of money for growth. You need to get the money to last you into your 90s if you live that long. We believe you need a bucket of money for income that you can tap into for reliable, dependable income, especially when the markets are down. We believe you need a bucket of money for long-term care and healthcare. Right. And then what about passing money on to your loved ones too, if that's important? So yeah, I like it, right? If you can think about your monies that way, and hey, I've got a couple $1 million, I've got $1 million, I've got 10 million, whatever it is, think about separating your monies for you to serve different purposes. Every single dollar you saved and invested should not be set aside for the same purpose, right? Again, you might have X amount of money saved, maybe it's $3 million, and you say, you know what? This $1 million of the 3, I want to spend down until the last check bounces. I do not care if 1 penny goes to my kids or grandkids. It's for me and my wife. It's for me and my husband. It's for me and my partner. We're going to enjoy it. We're going to spend every penny down. But the other $2 million, part of that I want to know it's going to be there for me in my 90s. Part of that I want to pass on to my kids and my grandkids, or I want to donate or tithe, whatever it is. And so I think it's really smart to be thinking about your investment portfolio and life savings in terms of buckets and how it can help you accomplish a bunch of different things. And some more for the article, I think that really can help develop income confidence. The rule of thirds is aimed to create steadier retirement income. It can also reduce the need to sell investments during market downturns to cover expenses if you have money set aside, right, that are safe, maybe principal protected. A response to changing times. Some retirees are questioning traditional guidelines like the 4% rule. The rule of thirds is gaining attention as an alternative for today's environment of inflation, longer lifespans, and higher costs. And it trades flexibility for stability. One caution is that converting a portion of savings into guaranteed income can limit liquidity if you decide to do that. And once money is committed, it may not easily be accessed for unexpected expenses, making this approach less flexible than an all-investment strategy. Well, you got to weigh your pros and cons of all of these different rules and find out what's best for you, right? And everyone has different needs and goals and objectives in retirement, and that's why we build customized plans that are specific to that individual or family.
Yeah.
We just recently worked with a family out of Northern Virginia, $3 million with us and a few $1 million that they're self-managing as well.
Wow.
Right here in Northern Virginia, pretty close to our office. And, the main problem when they came to us is that all their monies were scattered, multiple accounts. The husband's actually retired now, but the wife is still working. And, he wanted a firm to be able to manage his dollars so that if he passed first, everything could be handled for the wife and the kids.
Okay.
And that is a big reason why husbands and wives come in and say, they want to make sure each spouse is taken care of, the surviving spouse is taken care of, and the family's taken care of. Because oftentimes just one spouse is the main one really leading with the financial decisions, leading with the investment choices and all those things. We put together a retirement roadmap for this gentleman and his family, really showed him how to split up the investments to accomplish different objectives that he had, how to generate income, how to reduce taxes, how to pass on money to his wife and his kids most efficiently. That was all done through a retirement roadmap. You need a comprehensive plan. You deserve a comprehensive plan that you can follow, track, measure, know how you're doing as you're heading into retirement. Even if you're 10, 15, 20 years into retirement, how do you know how you're doing without a compass check, without something to follow and track, just like GPS in a car? That retirement roadmap, it's a comprehensive plan. We can show you how to protect your family, how to protect your life savings, how to preserve the assets, how to grow them continually, and how to enjoy them, maybe most importantly. If you're 55 years old and older, you've saved $500,000 or more, your life savings, dollars that we can help you to manage. We want to offer you your own customized retirement roadmap. Put together a plan, and we'll show you how you can enjoy income from the life savings that you've worked so hard to build. Complimentary.
Abe, we constantly talk about the review process here and getting your own retirement roadmap done. What can somebody expect to learn through that process? What is reviewed and revealed through a retirement roadmap?
Yeah, great question. Well, a retirement roadmap is just that. It's a comprehensive plan that pulls everyone's resources together, right? All of their resources, their, where their income's going to come from, their investments, their healthcare, their estate plan, their tax plan, all of it into one plan, because especially if we're married, we've got accounts everywhere, right? Between husband and wife. And even if we're single, we typically have 5 to 7 accounts out there that we need to pull together.
People change jobs very frequently nowadays. Yeah.
Yeah. So in that retirement roadmap, the first thing we look at, Heather, is someone's income in retirement. Where is all that income going to come from? Your Social Security, stocks, annuities, pensions, whatever it is. Then we're also going to look at taxes. Well, you have all this money coming in. You've saved all this money. What do taxes look like for you? Mm-hmm. We're going to look at healthcare. Are you on Medicare? Are you on your own private healthcare? Do you need long-term care? That estate plan is also very important. And of course, the investment plan is going to be inside that roadmap as well. What type of investments should you have for what we call phase 2? So it's a comprehensive plan that most retirees need in retirement.
So as I was saying, we're focusing a lot on our market, risk, investments, style, allocation, this half hour of the program, Abe. And when it comes to our market opportunity, I mean, you can't deny the certain companies that have been dominating the headlines.
Sure.
As if Apple and Meta and Microsoft are not sexy enough. Here comes Elon with SpaceX. And I think we got a couple more big IPOs happening before the end of the year, just to name a few.
Sure.
But Market Guard CIO Brad Jenkins, he is saying all that attention can actually leave investors with more exposure to just a handful of stocks, more exposure than they even realize. This is Brad Jenkins.
A lot of your listeners will probably know the term the Mag 7, right? The Magnificent 7 or the Big 10. These are a few stocks, think of it, 7 or 10 companies that have absolutely, in my opinion, manipulated the S&P 500, which is quote unquote the market when so many of us pull up our iPhones or we turn on the TV or the nightly news says the S&P closed at this and the Dow Jones and the NASDAQ. Well, here's the challenge. When you have 7 to 10 companies that can completely distort the performance of the other 493 companies, and we look at the S&P and we go, look at how great the market's doing. No. Look what's happening by these companies distorting what's taking place. So there's got to be a way to dig into it deeper. There has to be a way to filter through that. And that is what Market Guard helps to bring to the table.
And that is what you are here to also help clarify for us, Abe. The idea of the concentration that many investors might have and not even realize. It creates risk. It's built up in their portfolios, unbeknownst to them. They don't realize it until the market then does take a turn. So how can we stress test our portfolio for risk like that? How do you help guard against those kinds of things?
You do just that. Okay. You stress test it.
Yeah.
And we talk about that week in and week out. We call it a portfolio x-ray, but we'll run everybody's investments and 401ks and IRAs, TSPs, all of those things through software called Morningstar and other software we use as well, but we'll use Morningstar. It'll give us all the pros and cons of an investment, right? All the ups, downs, highs, lows, cost, and everything you need to know about a particular stock or even a fund or ETF. And so just like you get your car checked, once a year or twice a year, just like you get your teeth checked once or twice a year and your health checked. So should you do the same thing with your investments and your life savings. And this is one way to do it through a portfolio x-ray. And, Brad Jenkins, Market Guard is right. The risk is sometimes bigger than it looks. Heading into this year, as an example, the Mag 7 made up roughly a third of the S&P 500's total market cap. In 2025 alone, approximately 42% of the index's entire return came from just those 7 stocks. The other 493 companies combined accounted for less than 60% of the gains of that index. So don't be fooled by the index. When a handful of stocks are driving most of the gains, a portfolio can look healthy while carrying more risk than an investor realizes. We see that all the time because people want to be part of those hot companies. You just named a bunch of them earlier, Heather, and we have FOMO, and we feel like we're going to miss out if we don't get invested on the latest IPO or the latest company or the latest fund. But you want to focus on the whole plan. Focus on the forest, not the trees, right? And so we'll see people just get wrapped up in a company or companies. And so We just recently met with somebody that's also from Northern Virginia, 10 million.
Wow.
She's in her 60s, and all of that 10 million was in less than 10 stocks.
Yep.
Very concentrated in tech, not diversified at all, in our opinions. This lady was scared, concerned, fearful. Here's a lady with $10 million, but the $10 million was in less than 10 stocks, and just fearful and not knowing how to generate income from her plan because you didn't have a plan. $10 million in tech stocks, okay, that's fantastic. That's a wonderful job of saving. But how can we turn this into money you can actually enjoy instead of just being focused on the latest tech stock that's out there or the return that could be through the roof? How can we return this wonderful job of savings into enjoyable income? So we put together a portfolio x-ray for her, which showed her what she owned, the pros and cons of those stocks, the pros and cons of having all eggs in one tech basket, the ups, the downs, the costs, the risks. We recommended, of course, to diversify and to put together a plan to grow and produce income, which is exactly what she wanted. Really came in to figure out, how can I enjoy money now, right? I'm at the point where I feel like I've got a good nest egg. I don't have forever to enjoy this. Abe and the team helped me put together a distribution plan where I can replace my paycheck and enjoy income I could depend on for a long time.
Yeah.
That was all done through a portfolio x-ray. So wouldn't you like to know what you have and if it's the right fit for retirement for yourself and your family? We would like to offer you your own customized portfolio x-ray of your entire life savings. If you're 55 years old and older, you've saved $500,000 or more for your retirement in monies and assets that we can help you to manage. We want to help you put together that customized portfolio x-ray of your entire life savings, complimentary.
Abe and his team, they're here to help you do that. So it's theretirementkey.com to start the conversation, or you can just click on the links we've got posted in the show notes.
Thanks for listening to the Retirement Key Podcast with Abe Abich. To learn more about Abich Financial Services, visit theretirementkey.com and join Abe for his radio show, The Retirement Key, Saturdays at 8 a.m. and 2 p.m. and Sundays at 8 a.m., 2 p.m., and 5 p.m.
Abish Financial Wealth Management is an SEC registered investment advisor. Registration does not imply a certain level of skill or training, and the SEC has not approved or verified this communication. As a registered investment advisor, we are a fiduciary under federal law and owe our clients duties of care and loyalty. Abish only transacts business in states where it is properly registered or is excluded or exempted from registration requirements. This material is for general informational and educational purposes only and is not individualized investment, legal, or tax advice. Investment advice is provided only after engagement under an appropriate advisory agreement. Structured notes, annuities, Roth conversions, and related strategies involve risks and may not be suitable for all investors. Structured notes may involve issuer credit risk, limited liquidity, capped or conditional returns, loss of principal, and protection features that may not apply in all market conditions. Annuity guarantees depend on the financial strength and claims-paying ability of the issuing insurer and may be subject to caps, restrictions, fees, and surrender charges. Roth conversions are taxable events, and outcomes depend on individual circumstances, future tax rates, and investment performance. Third-party rankings or recognition are not guarantees of future results. Endorsements are representative of any client's experience. Criteria and fee information are available upon request. Any hypothetical or illustrative scenarios referenced in marketing materials are for demonstration purposes only, do not represent actual client experiences or guaranteed outcomes, and should not be relied upon as predictions of future performance. Investors should review all offering documents, understand applicable risks, and consult qualified financial, tax, and legal professionals before acting. Past performance does not guarantee future results. Endorser is not a client, and this testimonial has been compensated. Opinions are their own. Compensation may create a conflict of interest. Testimonials may not be representative and are not a guarantee of future results.